And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
It's that time of the week again. Good afternoon, Luke Smith.
Good afternoon.
The weeks are just whipping by, aren't they? Here we are. This is the last Friday of May. That means the end of the financial year is almost upon us.
Yes.
It's only 4 weeks away.
Frightening.
It's terrifying.
Yes.
Where did the
very much so.
time go?
I don't know. It feels like 2 weeks ago we were talking about having a break for Christmas and
Exactly.
yeah, now it's panic stations for things people have been waiting 5 months to do before 30 June.
Well, I've just paid last year's tax, so looking forward to this year's now.
Can't wait. Yeah, they never miss you, do they?
There's always, there's always something they find that you owe them money for, isn't there? Today we're talking about an interesting element of the superannuation system where you can sort of retire but not really.
Yeah, that's right. So we're going to sort of extend some of the 30 June thinking, and today we're going to touch on, could you use a transition to retirement to your advantage? Because there's a process to kick one of these off, and like really at the moment we're leaving it to the ends of the earth to try and get this done. But we've spoken about deductions, we've spoken about contributions. This is a great way of funding the contributions we've been talking about over the last 2 or 3 weeks, because a transition to retirement pension by name says that you are transitioning to retirement, which means you have not met a condition of release, or in English, you haven't quit your job. And that allows you in the ability to access your super with specific conditions, primarily that you've reached your Commonwealth preservation age, so generally 60, and you have the capacity to take between 4% and 10% of your balance from the 1st of July each financial year, or on a prorated basis if you were to start it during the financial year. Now you say, well, why is that important at the moment? Last week we spoke about the difference between deductible contributions and non-deductible contributions. Today we're talking about transition, because if you want a tax deduction before 30 June, transition to retirement is a great way to fund that contribution. And here's how it works.
All right, this is where it gets technical, folks.
Yeah, keep it really easy. We've got $500,000 in super. That means we can take up to 10% of our balance. Now, if we've got superannuation coming into our super fund, we know that the annual limit is $30,000. But if you haven't reached the limit in previous years, we've discussed in the past the catch-up concessional legislation. So to keep it really straightforward, you could start a pension today with your existing super, take 10%, so we can get $50,000 out. Now we pay no tax taking that out. We could then take that $50,000 and add it back into a superannuation fund where we have room in our contribution limits, and we could claim $50,000 as an income deduction, or any variation of what you need to get you to the $30,000 concessional limit, or to use any of the catch-up concessional space you may have going back to 2020. So a lot of people hear transition to retirement and think, oh, well, it's only good if I'm going to work 4 days a week. And I've got an example of that as well. But when you think outside the box, transition to retirement can be a great way to pay down non-deductible mortgage debt. It could be a great way to fund university or private school fees for adult kids or big kids. It could be a great way to fund a contribution to superannuation for a spouse. It could be a great way to fund a deductible contribution for yourself. So there are a range of reasons that a transition to retirement pension may be appropriate, but we need to make sure we're playing within the parameters, and that is that you take between 4% and 10% of your balance each financial year. Now, leading into June, great time to be thinking about it, because if I extend that example, we have $500,000 in super. We take $50,000 out now, we pay off our house. 1st of July, we take another 10% of the balance. Now we've got $45,000 we can take out. We've got $95,000 paid off our non-deductible home loan. We've paid no tax taking the money out of super. So you pay $95,000 off with tax-free money. Depending on your marginal tax rate, you might need to earn $120,000 or $130,000 of equivalent income to get that amount after tax in your wages. So I want people to think about transition, because a lot of people associate the word pension with a fortnightly amount. And the word pension does not mean fortnight. It simply means the act of starting an income stream out of super. The frequency with which you take your payment is completely up to you and your situation. So TTR, or transition to retirement, is wonderful if you say, well, look, from the 1st of July, boss, I'm not really feeling 5 days a week. I'd love to go to 4. So if we think about the cash flow cost of that, you're going to lose 20% of your wages. So you're on 100 grand, you fall to 80. But if you had 800,000 in super and you took 4% over the course of 12 months, you're going to get $32,000 out tax-free. You'd actually have better cash flow than you would have if you were working with $20,000 of additional income. So transition to retirement is really powerful, but you need to go to your super fund. You need to ask to have it set up. One caveat I do have here is think about what's going to happen going forwards, because a big mistake I find people make is they go, I've got 500,000 in super, start a pension with all of it. Now, one of the rules associated with a pension say we cannot add to its capital value. So you can't have superannuation guarantee from your employer go into that pension once it's started. So if we had 500, it would be a great idea to take 490,000 and start a pension with that, and just leave 10 grand in your existing fund, because you're still going to need somewhere to put your contributions, work's contributions. So you'll end up running 2 accounts. But it's a wonderful way to get access to money, but then keep your contribution strategies in play. And it's something that you must go to your provider and say, I would like to start one under these parameters. And they will ask you on the form, are you at your preservation age? Yes, I am. What would you like to do? I'd like to start a transition to retirement pension. How much would you like to take? Where would you like it paid, i.e. which bank account you want it in? And when would you like the payment? So if we're going to take 10% this close to the end of the year, you want all of that paid immediately. From the 1st of July, you might say, well, pay me on a monthly basis, pay me on a fortnightly basis to manage your cash flow if that's what you're doing. So it's very flexible, it's very powerful, it's very useful for paying off debt, and it's a great way of funding deductible contributions to lower your taxable income.
Now, at the beginning of this, you said a lot of people think if I want to move to a transition to retirement pension, I need to quit my job. And you said, no, you don't. You don't need to quit your job.
Correct.
But you do have to meet certain conditions, don't you, in order to qualify?
Well, yeah, you need to be 60 years and over. So you need to be able to access your superannuation. If you are in certain defined benefit schemes, primarily CSS, you need to change your work hours. So if you're doing 40 hours, it'd be great to get your boss to agree to do 38.5. Other than that, you can go to a retail super fund. So if you're in an industry fund or a retail super fund, you don't need to change the hours that you work. You just need to complete the paperwork to make the election to take a portion of your accumulated super and start an income stream in a new account. Outside of that, there's nothing from a legislative perspective that you need to do in relation to your gainful employment to be able to take advantage of this legislation.
So on that basis, it's actually remarkably easy.
Yeah, it is. Look, it's not a difficult process to undertake. It's getting people to think outside the box as to what's the use of the money. Because another comment I get a lot is, oh, but then my super's gone down. Yes, but if you've taken, in that example, $90,000 out of your super over June and July, which is 2 years of payments at 10%, you might then go to your mortgage provider and say, look, recalculate my mortgage payments because I've just put $95,000 into this debt. Your mortgage payment will fall because you now have more equity in your home. Therefore, you could now make larger contributions back into super to keep saving and lowering your tax, knowing that next July you can take another payment and lower your mortgage if getting rid of the debt on your home is your primary objective. So it's really about tailoring the use of the money to the situation that you're in. With interest rates where they are and a lot of properties being negatively geared, transition to retirement out of super, great way to try and neutralise the difference between rent and interest so that you can hold a property long term in a neutrally geared position. So there's a myriad of applications. It's about understanding if it's applicable for you. identifying what your primary objective is of using it, and then the mechanics and the paperwork of kicking it off.
The one that really catches me up, though, is apparently, if I've understood this correctly, I could take money out of my super through a transition to retirement plan. Yep. And then contribute it back into super again.
Totally.
When I take it out, it's tax-free. Yep. And when I put it back in, I get a tax deduction for putting it back in. Somehow I've magically made money out of nowhere.
Well, you've used a portion of your accumulated super for a far more tax-effective application. Yeah, 100%.
It's like magic.
Well, and that's why we're talking about it, because everybody loves a deduction and they come in on the 25th of June and say, well, what can I do? That's why we're talking about it 4 weeks from the end of the year, because your super provider will need some time to separate the account, create a new one and kick it off. The other thing I will say about moving accounts, the question I get a lot is, but what happens to my investments? The answer is nothing. If you're in the balanced option in your super fund and you go to transition, you can pick the investment option that you want in the pension account. It stays invested, it continues to grow. Whatever happens in super will happen in the transition to retirement pension. There is no manipulation or change to the underlying investments themselves. All you're doing is simply accessing a portion of your capital as a pension, which can be paid on an annual basis if you wish.
And I presume not triggering any capital gains tax events.
No, moving to transition to retirement isn't, again, no change to underlying assets. You take the pension payment out. If you're in an industry fund, it's taxed at a fund level, so you won't get a CGT bill. If you've got a self-managed super fund or a retail super fund and you sell assets, then a transition to retirement pension still incurs capital gains tax.
Right.
And it's still taxed at 15% on the earnings like normal super. It's only when you fully retire that a transition to retirement becomes an account-based pension, or when you hit age 65 by default, and a transition to retirement pension becomes an account-based pension because 65 is maximum preservation age. But a wonderfully powerful strategy.
Yeah. Luke Smith from Envision Financial is in the studio today, and we're talking about the transition to retirement arrangements and how they can be very effective in helping you reduce your mortgage or reduce your tax bill or just generally leave you in a better off position overall. So, Luke, What are the key things to consider when starting a transition to retirement pension?
Yeah, if you want to use the legislation and reduce your work hours, I guess the first thing you want to do is have a chat to your boss. That's obviously, I find, with a lot more notice.
See, when you talk about cutting back to 4 days a week, I still want to get paid the same.
Yeah, that's okay. And that's
I'm not sure the boss will go for that.
No, but that's why we go down this road, right? Because people don't want to see their cash flow drop, but they'd love to have a Friday off to play golf in the sun. So have a chat to your employer. Like, they might want you out more than you think. Mm-hmm. You know, I have a lot of people come in and go, well, my boss won't let me. I say, have you asked? Well, no, but they might be, they're human, right? So they've got families and they've got kids and they've got spouses and they've got things they like doing, and they might be completely supportive of it. And I find if you give people plenty of notice, you generally get a really good outcome. Remember that you will need to run 2 accounts, so don't start all of your superannuation as a pension, because you'll have your employer ringing you up saying, hey, your super's bouncing, what's the problem? So keep at least $6,000, but check with your fund as to what the minimum is. Generally, it's $6,000, and then have your employer contributions continue going where they are and start a pension with the balance of your account. You've got to take between 4 and 10%. That's each financial year. So if you want to be strategic, take 10 in June, take 10 in July, and you've got 2 years of maximum pension payments in the space of 4 or 5 weeks, which is great. Use it for things that you would otherwise pay after-tax money for. So not just reducing your work hours, but think about paying down your mortgage. Think about getting an investment property neutrally geared. Think about paying kids' uni fees, right? If you can pay $10,000 off instead of $13,500 of gross income, it's a better use of the money and a greater application of value. Use it for things outside of the box if it's appropriate. But leading into June, also remember that it's a great funding mechanism, as we said before the ad break, great funding mechanism for deductions. So if you've got $30,000 of contribution cap and you've only used 15, look in your super and say, hey, can I get 10% out? Put in the 15,000, claim a tax deduction. You might put the rest of the money in July if your 10% is more than you need to put in to get a deduction. So remember that it's not just this year, you can use it for next year as well, and you've only out of the market for 1 or 2 weeks. But don't do this on the 25th of June. You need to be talking to your fund now. You need to get your paperwork. You need to kick things off because funds are under immense pressure this time of year, trying to keep everybody happy with contributions and deductions and payments and pensions and lump sum withdrawals and everything else that's going on. So don't leave it to the last minute because, as we said in previous shows, the 28th and 29th this year are Saturday and Sunday. So you're going to need to have this sorted by the end of that week prior to the 30th of June because the money must be cleared and in your super for it to be deductible this year. So don't leave it too late because they're not going to make any contributions on the weekend. And have a chat to your family. Between a couple, you might be able to get a huge amount of money against the mortgage in June and July if you both do it. And remember that you don't have to, in the majority of situations, you don't have to physically change your work hours. You can still do 5 days a week, you can still get full remuneration and still take 10% of your balance before 30th of June. You don't need to quit or reduce your hours to be able to do this.
Well, we've certainly covered a lot of territory today. Where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. That's Envision with an E. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. You can subscribe and like Envision Financial Canberra on YouTube, where we've got a back catalogue of all the shows and you can watch them on your phone. And all of these types of strategies are in Smart Money Strategy, your ultimate guide to financial planning, in all good and bad bookstores and online.
Fantastic. Thanks very much.
See you next week.
Luke Smith from Envision Financial back with us again at the same time next Friday afternoon right here on 2CC.